The 3 decades of restrained volatility of business cycles and the coexistence of price stability and uninterrupted growth that preceded the global financial crisis perhaps lulled central banks into the belief that inflation expectations are enduringly anchored. The beast of inflation of the 1970s and 80s and the early 80s seemed completely behind our times. Conditioned by that experience, central banks shed their role of lender of the last resort and became lender of the first resort to defend their financial systems when they responded to the global financial crisis 2008. Central banks continued from their GFC moment and once again rushed to the front line as warriors of the first resort to protect and preserve lives and livelihood when the COVID-19 pandemic hit the world. Central banks took interest rates to all-time lows, undertook unconventional policy measures to reach out to interest rates across the spectrum, including at the longer end, and gave assurances about low for longer interest rates. This was an uncharacteristic departure from the monetary mysticism that had prevailed up to the 1990s. Clearly, central banking has evolved in line with the developments of the 21st century. While the pandemic time measures provided the much needed support to the economies, in the aftermath of the pandemic, the limits and downsides of easy monetary policy in protecting economic activity in a crisis period became more evident. Today, rightly or wrongly, the central banks are accused of distributional consequences of their actions. The negative equity that weighs in the balance sheets of certain central banks is seen as compromising their independence in the conduct of monetary policy. The story in India was, however, different, as most of our liquidity measures were calibrated and carried end dates at the time of their announcement itself. Another challenge staring at central banks today emanates from soaring public debt caused in a considerable measure by the pandemic-related fiscal stimuli and the subsequent efforts for fiscal consolidation not gaining adequate traction. Such a situation is becoming a binding constraint on monetary policy in several countries. Global public debt has surged post the pandemic to 93.2% of GDP, of world GDP in 2023, and is likely to increase to 100% of GDP by 2029. And these are the estimates of the IMF Fiscal Monitor, which was released in April 2024. In major economies, debt to GDP ratios are on an upward trajectory, raising concerns about their sustainability and their negative spillovers for the broader global economy. In several other countries, central banks are willy-nilly expected to facilitate financing of such huge public debts. In fact, the debt overhang is simmering underneath the radar of central banks, threatening to unanchor inflation expectations and undermine macroeconomic stability. For emerging markets, central banks, that is EME central banks, for EME central banks, the international dimensions of monetary policy continues to be a testing challenge. For them, the trilemma is real. Today, the global economy is more financially integrated than ever before. Monetary policy actions in systemic economies produce large fluctuations in capital flows and exchange rates, which can then feed into the domestic liquidity, inflation, and eventually affect the real economy. While monetary policies in systemic economies are determined by their domestic inflation growth considerations, they have large spillovers to the emerging and developing economies and even to some of the other advanced economies. These spillovers can be expected to accentuate as capital flows dwarf trade flows. Quite naturally, Emerging economies are having to strengthen their policy frameworks and buffers to manage this external flux and mitigate its adverse consequences.
If you like the video, do like, comment, share and subscribe.